This question involves a classic net present value calculation. The best way to start one of these questions, in my opinion, is to lay out the cash flows. So let's look. They're going to invest $440,000 in this project. So we will first of all have our initial investment. And the time period for that is going to be right now. Okay, so the cash flow is $440,000, and that's going to be negative. That's money going out the door. Just think about you spending that kind of money. You'd be sending that money out the door. The present value factor is going to be 1, and the reason is those dollars are already converted into present day or current day dollars. So the present value is going to be equal to the cash flow. We also have to invest some working capital. You might remember that working capital is basically kind of like seed money that the company will have to invest right now to pay for operating expenses that are initially required to get this project up and running off the ground. There's probably going to be a lag time between when we start manufacturing something with this machinery and when our customer ultimately starts paying us. And we've got to have a way to finance those expenditures during that period of time. That's called working capital. That's money that we're going to tie up right now, so we're going to express that in present day dollars equal to the cash flow. Then we have the good thing. Every year we are supposed to receive cash inflows, and the question tells us we expect $123,000 each year. As far as the time periods covered, that's going to be each year for the next 1 to 5 years. Now we have to think about present value tables. This is an annuity. Think about annual being something that happens periodically. So we want to look in the present value of an annuity right here. And the discount rate is 11%. We're going to work with this column. And the period of time is 5 years. So the discount rate for 11% over 5 years is 3.696. We're going to multiply the annual cash flow by this amount. I probably should emphasize that we're simply multiplying here. So the present value of those cash flows is going to be a positive $454,608. We have 2 more cash flows to deal with. We have the salvage value. This machinery or this equipment that we've purchased for $440,000 is supposed to have a salvage value of $49,000 at the end of the project. So 5 years from now, we estimate that there will be a one-time cash injection of $49,000. Obviously, it's just an estimate, but we have to work with what we have available. This is where we need the present value table for a single sum, or a single, would help if I could spell the word single correctly, a single dollar amount. This is not the annuity. This $49,000 is not an amount of cash that we're going to get year after year. It's just a single cash flow. So we still use the 11% in the 5 years. We're going to be looking at 11% over 5 years, and we obtain the present value factor 0.593. Let's plug that in here, multiply, and we get a present value 29,057. It's worth mentioning that the present value of your cash flows will be lower than the future amount. This future cash flow of $49,000 has a present value of just over $29,000. As you're completing one of these problems, that's a good way to double check yourself to make sure that at least the present value is lower than the actual cash flow. That's one way to potentially catch any errors you might be making. Then finally, working capital. That money that we held hostage up here is eventually going to get released once this project has been completed, and then we can use those funds and deploy them toward something else, whatever the next best alternative would be. That's a cash flow that also happens at the end of the 5th year, just like the salvage value. So we will use the same present value factor that we did for the salvage value. And the present value of that cash flow is $20,162. Finally, this question is asking for the net present value. That word net really means to combine all of these cash flows. So if you add these positives, subtract these negatives, the NPV, or the net present value of this project, is just under $30,000, $29,827. And let's talk about what that means. That means that the return on this project is greater than the discount rate. It's greater than 11%. The decision rule with net present value is just this. If the net present value is 0 or greater, then we will consider this to be an acceptable project. If the net present value is less than 0, then this project is presumably not acceptable. It's not up to our standards. So in this case, it looks like it's a go. We should probably invest in this project because it has a positive net present value and would meet our requirements.